In this video, we're going to go through an example of building a cash flow statement from the other two statements that we generated at the end of the accounting cycle. So in a cash flow statement, we're going to be looking for cash from operations, cash for investing, and cash from or for financing that will then reconcile the change in the cash account. So that's what we're going to be doing in this video. So we always start with the other two statements, the income statement. In this case, we have income, all the itemized expenses, to total expenses to net income. And one of the things that we need to recognize is depreciation is a non-cash item. It is not a negative to cash flow. So we will handle that within the cash flow statement. The other thing we need to know is the balance sheet, but we also need to know the beginning balance sheet and the ending balance sheet. In this case, we have June 30th as the beginning balance sheet and July 31st as the ending balance sheet for the month of July. So we'll look at changes in a lot of these accounts. So when we go to this cash flow statement, the first thing we want to do is say, well, what is the change in the cash account that we're trying to analyze? So if we look at the cash account, it started at $1,000 and it went up to $1,200, which is an increase in cash of $200. And the question is, where did that come from? How did we get that increase? So we'll put this as the bottom line change in the cash account. And then, so to start with cash from operations, we're going to itemize sort of these three areas. They will always be the same in a cash flow statement. So the net income, we're going to go to the income statement, and we have this $300 to start with. So we're going to go ahead and put that in there. The next thing is depreciation expense, which is added back because it's a non-cash item. So we go to the income statement and grab off the depreciation expense and put it in there. And then the next line item is probably the most difficult to understand in a cash flow statement, but this is money that we needed to invest or was released from the operations that we call working capital. And it's easiest to think about working capital like inventory. Like we needed more inventory or less inventory. If we needed more inventory, we needed to take some of our money and buy inventory. So we used some of our money that way. If we have less inventory, that released money into the system, into the cash account. So we're going to look at the change in working capital. Working capital is defined as current assets minus current liabilities. But in this case, we want to exclude cash because the cash account is the thing that we're trying to reconcile. So what we do is we're going to take all of the current assets, these numbers here, the current assets. We're going to take out the cash because we want to exclude it, and we're going to take out current liabilities because working capital is defined as current assets minus current liabilities. For this special case, we also want to take out the cash. So we do this for the beginning balance for the June 30th numbers, and we do this for the ending balance, July 30th numbers, these values here. So this is the accounts payable that's going there, the cash account's going there, and the current assets is going there. So that's a decrease in working capital, which means it released money into our banking account from the working capital. So we're going to take that $550 and we're going to put it in, decrease in working capital, which is an increase or a positive in cash flow. So now we have our cash from operations, which is $1,050. So we started with $300, we have non-cash items, and we got money from our working capital. So we're going to say, well, did we use that to invest in any long-term assets? So we're going to look at this line item, which is the long-term asset number. Did we have an increase, did I have a change in that? Now, it's not the net long-term assets, it's not this value because that includes accumulated depreciation, and we don't care about that, that's a non-cash item. We just want to know what this number did. So what happened is it increased for $1,000, so that's a negative to cash flow of $1,000. So we're going to put that in the cash flow statement. That's pretty much all that happens in the investing area. So the next thing we want to look at is financing. So this includes both long-term liabilities and equity. So we're going to look at these two sections. We're going to first look at long-term liabilities. And what happened there is we had an increase in long-term debt. We probably got a new loan. So that was a positive of $600 to cash flow. So we're going to put that in that line item. We're going to look in equity. And equity has two parts that in the equities account. The first is the invested capital and the other is retained earnings. So if we look at invested capital, we can see that it increased $600, probably through a stock issue. So that's a positive to cash flow because we got more money for issuing more stocks. That's a positive to cash flow. In the retained earnings way, it's easiest to look at this because we actually captured retained earnings somewhere else. We captured net income for the period somewhere else. So let's look at, we start with 2,300. We had some net income of 300, right? But we already included it in the cash flow statement as the first line item, so we don't want to include that. We also had an ending balance of 1,550, which we picked up right here. So this is the beginning, this is the ending, and we knew income is that amount. So that means that what had to have happened is we had to have, just by difference, it had to have a dividends of 1,050. And we take that number and put it into the this value for long-term debt. So what we did is this 450 came from 600 that was issued for stock, less dividends, which is a negative to cash flow. So we have a negative 450. So we add up those values. We have, in this case, we started with 1,050, subtract out 1,000, and we added 150. That equals 200, which is great. It means that this is our change in cash account, because remember, we started with that number and we were trying to reconcile this, and they match, so we're very happy. So that's how you create a cash flow statement.